Howdy, Jacob here. Today we're looking at Cirrus Logic in the semiconductor and equipment industry, 7.1 billion market cap on 6.6 billion enterprise value, founded in 1984. They develop low power, high precision, mixed signal processing solutions in China, the United States, and internationally. Their growth in revenue is almost double over the last 10 years from a 917 million to 1.8 billion, with gross margin increasing, operating margin increasing. Gross margin about 50%, operating margin close to 20%, no dividend paid, and a return on invested capital in the low double digits, low teens average. That's with a heavy increase in R&D, over double increase in R&D expenses, share count going down from 10 years ago. So if you own one share, you own a little bit more equivalently. Or if you own 1% of the business, you own a little bit more. At the end of 10 years, due to share repurchases, cash is up a lot. 527 million cash-like products with zero short-term debt, zero long-term debt, 415 total liabilities. Very safe from a balance sheet perspective. Cash flow statement has capital expenditures roughly flat from 10 years ago with over double cash from operations. So a much heftier production of free cash flow, with most of their money going into share repurchases and reinvestment. That's great. A little bit on acquisition side, two large net acquisitions last 10 years, but really it's just a lot of investment and a lot of share repurchases. Let's make our assumptions. I think that I'd probably feel pretty comfortable with 7%. That's almost doubling at the end of 7 years. I guess that's just 60% up at the end of, because it's 10 years, yeah. So at the end of 7 years, going up 61%. I think I feel fine with that. That matches pretty well with what they've done historically, and this is assuming that 50% of cash flow goes towards acquisitions and reinvestments. So I feel pretty good about 7% return. I think they can definitely do that. As for margins, let's do a little bit of a range here, 15, 17%. 1% share repurchases is about 71 million, 140 million, 200 million. I think 2% is a little bit of a stretch. I mean, maybe not. I guess 2% is pretty reasonable if their cash flow keeps going up like it's been going up. So let me be a little bit on the stretch side with the PE. Good return on invested capital, not fantastic, but definitely good, over market average, and an over market average rate probably at the end of 7 years, right at the market average for revenue growth from that point. We'll put it as 17 PE at the end of 7 years. 15% return that I'm looking for, and we're saying the company stock price needs to fall 54% before you get the return we're looking for. Again, I think fantastic company. I would just want to get it at a price that is a little bit more appropriate, but I think you can definitely get it at a premium based on the company's performance of the last couple of years. Good return on invested capital, increasing margins, very solid growth, good reinvestment. They're not just high return on invested capital, buying back shares, paying a dividend. This is buying back shares. Hopefully they're strategic with it, and then reinvesting back in themselves, hopefully to get that 10, 15 plus rate of return. Either way, I hope you enjoy the video and have a great rest of your day. Thank you.